All right, we are going to talk about two of the more interesting real estate investment trusts or REITs in the market. Before we do, please take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support this work that we're doing. So, two really interesting REITs right now. One has been in the news a lot over the past year, so it's called Medical Properties Trust. Ticker symbol is MPW. They are a medical office REIT that they were beaten down for a while. Then, because of their dividend, they were paying something like a 20% dividend at one point. Then the dividend got cut because everyone said it was going to get cut, but no one believed them. Then it got cut, and then the stock went down again. And it's kind of been a roller coaster ride, down the hill for medical properties, I guess I would call it. But Tyler thinks it might be a little interesting on paper, at least. So, Tyler, what are you seeing valuation wise? Because I like stocks that are trading for less than their book value. So, what are you
Yeah.
seeing?
So caveat, this is purely from looking at like screening numbers and things like that, and this is why it popped up to me. I'm not making any. This is before making any judgments of the business, but obviously I do spend a lot of time just kind of making market screens and looking for cheap assets. And Medical Properties Trust came up on one of my screens recently because it was trading for so low. As of right now, it's currently trading for 0.4 times tangible book value. So basically the market's saying that its tangible assets are worth 40 cents on the dollar, which is extremely cheap. And on a price to free cash flow basis, the stock trades at 5.85 times. Now, I know that because of REITs, you don't normally speak about REITs on a price to free cash flow basis, but even by even we throw all the adjustments in the world, that is objectively cheap. And so you look at both of those things and you say, like, there is either something really, really wrong in the balance sheet in these assets, or the market has wildly overreacted. Now, we've talked about this one a couple times, and I have taken the negative stance on it, basically because there's been some talks about them overpaying for a couple assets. They've had this weird deal with one of their operators who has not been very good about making payments, both to medical properties and to other companies as well. So there's always been, and that's been kind of the thesis behind a lot of short reports, basically being like their accounting's not very good, they've overpaid for assets and things like that. And so that would be the argument, is basically saying it's like what your market screen says isn't the truth, because what those balance sheets say is wildly overinflated.
Yeah, and that's really the key point, right? With real estate, because usually real estate, if in a healthy environment, trades for more than its book value, significantly so in a lot of cases, because the price you see on the balance sheet is what they paid for the property. And in many cases, it was, 2, 3, 5, 10 years ago that they bought these properties, and real estate values should go up over time. Think of some of our
And
favorite REITs,
and they go
Realty Income
down on the
Trust.
books, and they on a
Right, and they
balance
go
sheet
down
the
on the
value
books
goes
because
down.
of depreciation.
Yes.
Yeah, the depreciation makes the value actually go down on their book value. So think of like Realty Income. If they buy a convenience store property, they paid $1 million, 10 years ago. They could probably sell that property for 1.5 million, $2 million in a lot of cases, depending on what market it's in and things like that. But on the balance sheet, it still says that they paid $1 million for it. But now there's depreciation, so their carrying costs might actually be like 900,000 or less in some cases. So in if you see a REIT that's trading for, say, 1.5 times book, that doesn't mean it's expensive. That means that the value of its assets went up over time. So in medical properties case, the market's telling you the exact opposite's happened. It seems like an extreme discount. Are their properties really worth that much less? Is the equity in their properties worth that much less? Meaning that, while their debt has remained the same, the difference between their property values and their debt load has really compressed. That could definitely be the case, but 0.4 times book seems really cheap.
Yeah, the only argument, another argument I guess you could say against too, is like right now it still has a dividend yield of somewhere north of 11%, which is basically kind of the market saying, look, you're still going to have to cut. And if, going back onto its cash flow statement, like even after its most recent cut to the dividend, its dividend payments still exceed cash from operations. Now, again, they're REITs. Sometimes you can play around a little bit with what is cash from operations, what is funds from operations. They can make some adjustments based on like what's maintenance capital, what's growth capital. But the fact of the matter is like they're probably, because of, like you said, because of where their assets are and how cheap the stock is, they probably can't raise equity. Debt is probably not their best option right now. And so like if you can't really grow, that means like cash from operations should mean how much you can use to pay your dividend. And if your dividend's too much, that probably means you're going to go for a cut. And so it's a really competing tale, because I think a lot of time investors will look at things like screens and immediately go, oh my gosh, trading for 0.4 times book, it has to be cheap. I have to go buy it. But then you start digging into it like we've done here, and you go, well, maybe the story that the numbers are telling us isn't the whole thing.
So the other one you wanted to mention is kind of the opposite case. Um, it's a company called, not that its asset values are inflated, but it's a company called STAG Industrial. Ticker symbol is STAG. And we've talked about this before, and we've talked about other companies in the industrial real estate space, right? Because it's a very, very hot sector of real estate over the past few years. They can't build these properties fast enough, or at least they couldn't. Stag, I know, is we've talked about it in somewhat of a negative tone, and primarily because they have mostly grown by just raising capital and buying new assets, and just kind of continually diluting shareholders, things like that. So I know that's been an issue in your mind, but does Stag seem too expensive, or is it comparable to other industrial REITs right now?
I, that really, it's depends, I guess, sort of question. Because if you look at it from, let's say, Prologis, largest in the business, or some of the other industrial real estates that have grown their dividend rather quickly, like Rexford Industrial or Toronto Realty, Stag Industrial looks cheaper. If we're just going to use dividend yield as a proxy for cheap and expensive, Stag has a dividend yield somewhere in the 4.5 range right now. All the other ones that I just talked about in the low 3s to the mid 2s in terms of dividend rates. So that would say that Stag is cheaper, right? But the difference being is that Stag's dividend just hasn't grown. So if you have that component of dividend growth and yield that ends up being your total return over time, because obviously if you have yield on equity, you want that dividend to grow. You want it to get bigger. That's the point of owning equity, because it gets bigger over time. If I wanted to own, a payment that just pays me the exact same thing year in, year out, I'd go buy bonds. Why not? It's a safer asset anyways, right? And that's where things can get a little, I guess you could say, confusing and harder to understand with Stag. Because if you look at the big numbers, you always look at net operating income, you look at funds from operations, all those numbers always growing at incredibly fast rates. But then you look at the per share numbers, and the per share numbers just haven't grown. From 2014 to today, Stag's monthly dividend payment has grown 1 penny. So I think it was 11.2 cents in 2014, and now it's 12.2 cents today. So almost 9 years to basically grow 12 cents. That's not a lot. And so as an investor, if I'm looking for equity, I want both the component of growth and yield, and that just doesn't match up, right? A 4%, 4.5% that barely grows at all, to me, is just less compelling than something that maybe I take 1% less in yield, but is growing at 8, 9, 10, maybe 12% annually. And so that's where I get confused. On paper, it says Stag is cheaper, But when you add the component of growth, then all of a sudden STAG looks a little bit less compelling.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.